It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. We are managing your financial future. Welcome back to the podcast. I was going to say this is episode 2 of the new season, but really we stopped counting. So I will say this is episode 2 of 2023. How's that? All right. It's the second episode of the brand new year.
Still weird saying that.
Professor Rick Plum, certified financial planner, professional, CFP type.
Yeah, that's me.
If I said that correctly. And welcome. I'm your podcast host, Johnny Dean, not your... Not an advisor, but the guy who facilitates all this stuff, and I learned so much.
You're my enabler?
Kind of, in many ways, and you are mine. We've been talking about this stuff for so long that I'll tell you what, today's topic, though, we haven't talked about this stuff because we haven't had an opportunity based on interest rates. And that's the discussion today. And we're going to talk about interest rates in a bit with regard to the bucket strategy and all that stuff. But this got me to thinking here. I was talking to Chris Lloyd, you know him, our the Phoenix and Scottsdale advisor, right?
Yes.
With Lucia Capital Group. And he was talking about how he gave me some information here, which I found interesting. Now, first of all, Rick Plum, the interest rates now...
A little bit different than they were a year ago at this time?
They are a lot different than they were a year ago at this time, and we didn't expect this. Nobody expected this a year ago, and so this kind of caught people by surprise.
Very much so. It very much caught the markets by surprise, both the stock and bond market. The bond markets took it on the chin, and with interest rates going up and people not hedging their portfolios, not protecting themselves from rising interest rates, a lot of portfolios that had bonds in them, existing bonds already in them, balanced portfolios, fixed income portfolios, lost a decent amount of value over the year.
Absolutely. And for whatever reason, people did not expect this to happen. Maybe because for 12 years or more.
I mean, how many times did we think it was going to go up and then it'd go up a quarter point and then not go any further? We're like, so we got lulled into the fact that nothing's going to affect this for a while. We got so used to the status quo.
Well, we did. You're right. It was only little dribs and drabs that we thought, well, what are interest rates going to be at the end of 22? Maybe a quarter point higher. We're not going to make too many moves based on just a quarter point, if that. And so what the Fed did was, in an effort to tame really a temporary situation, but they've used this technique for years, which is to get people to stop spending money. And what is that? Well, you reward them for holding on to their money.
Right. You give them an interest rate so that they say, I don't want to take my money out of savings. Look what it's helping me. Look what it's doing every month. It's making me money.
That's the idea anyway, and I suppose it's helped. And
it makes it more expensive for borrowing.
It does make it more expensive for borrowing, so that means people are less likely to buy something on time.
Well, hopefully they are, but unfortunately, a lot of people keep borrowing until they realize, oh, wait a minute, this interest is getting expensive every month when they carry a balance from month to month.
For some people, have high interest rates ever stopped them from borrowing?
Some people know.
Some people, it's 28%, and they're still throwing money on their credit card.
Do I have room on my balance? Or do I have room on my my card? That's fine. I can.
Yeah, I'll just pay $104 a month instead of $101. And whatever it is. So that's the idea of raising interest rates. We haven't had it this.
Now remember though that the Fed only controls the very short-term rates. They don't set the rates for the 2, 3, 5, 10, 30-year bonds that the government issues. They only control the very the shortest of short-term rates. And so the rest of the rates are controlled by the market and
right.
What people are willing to put their money into and what reward they need to get back out of that investment to make it worth their while.
Yes.
And it's interesting because we are what everybody calls inverted on the yield curve.
Explain for people, we've talked about this before, but explain briefly for people who don't know what that means and why that's important.
Well, if you graph the return, the yield, the earnings on a particular maturity of bonds, typically, if you start off in the lower left corner of your graph, You've got your short term, and it's got the shortest time to maturity, meaning you're going to get your principal back, and it's the lowest rate. And then as you go out over time, the interest rates get higher and higher, and the longest. So you've got a curve that kind of goes up to the right on a graph, and that's a typical yield curve. But right now, short term rates, the 6 month, the 1 year, the 2 year, those rates are higher than the 5, the 10, and the 30-year bond rates from the government, or what bonds are paying at that particular maturity value. So instead of seeing a nice graph that slowly rises as you move to the right, it goes up from 0 days to very into the 4% range, and then tapers down. And so it's instead of going up over time, it goes down over time. And once you get past maybe 7-8 years, it's pretty much flat. I mean, at least you're within 5 or 10 basis points across the whole.
There's almost no difference between holding your money for 6, 7, 8 years as there is for 20 years.
Right. And
whatever.
So what's happening is the market is saying we see this interest rate environment as not a long term. Now, that doesn't mean they're right. It just means that investors are saying, I'd rather lock in for, if I really want to be safe and I want to be a longer term investor, I'll buy a 10 or a longer year bond, because I think even though I'm giving up a little interest over the next year or two, they think interest rates will be lower for years 4, 5, 6, 7, 8, 9, 10, and over the period of time that they're locking in, that they'll do better, even though the interest rate is slightly lower at the moment. Because when that 2-year bond comes due, they expect it to be lower than where they're earning on the other bonds. And so we'll see. I don't know if that's true or not. We'll see.
Well, we don't know, but what they're trying to do is grab it while they've got it. Take it while it's hot.
Right.
And the last time, according to the stat that I got from Chris Lloyd, the last time we saw 2-year Treasury rates over 4% was 2007.
It's been a while.
15 plus years now, more than 15.
Yeah, we got to get our math back in shape.
I know. I'm no longer on 22. I'm on 23. And by the way, when we mention these interest rates that we're talking about, this is really kind of right around the time we're recording this.
And they can change.
They can. So if you're hearing us say it's in the low 4s, high 5s, whatever it is, maybe by the time you're listening to this rather, it's changed. But the idea is still there. 15 years ago was the last time 2-year rates were over 4%. Now, of course, you don't have to go out 2 years to get over 4. 6 months, 6-month bills have been, at least for a little while, at the time of us recording this, have been over 4% for a little while.
Yeah, so and towards the higher side of the 4s. It's not like 4.01.
No, we're talking
4.5, 4.6, 4.7.
Exactly.
And it's interesting, it's a very large interest rate, because we look at the rate that the Fed does control, which is well over 4% right now. And a year ago, it was under a quarter.
As in 1/4 of 1%, under 1/4 of 1%.
It's now over 4, mid-4s.
What was it? 0.
It was
something.
like less than an eighth.
0.1.
0.7, 0.1, 0.07, excuse me. It was just very, very low.
And now we're at 4 point
something, 4 or 5. It's up there.
Depending on when you're listening to this again.
Yeah.
So this is not a gradual increase. This is
a fairly sharp
is a large increase, which should, whether it's temporary or not, I don't know. I have a feeling they're going to leave these rates alone for a while. But when you have a sudden shock to the system, anytime you have it, when you have a big gain in stocks over an unexpected gain or drop, people say, well, I need to do something. I need to react. Oftentimes they react incorrectly. But I wanted to talk about this, what people may be able to do, what you think people may be able to do, given this completely unexpected interest rate rise that we've seen over the last 12, 13 months or so. What do you see? First of all, how have interest rates affected the way you guys put together the bucket strategies over the last 10 to 12 years? When interest rates took their dive, and it did it fairly quickly. It was only over a year or two, or a couple years, right, during the 2008 financial crisis. But it changed the way, I would suspect, you put together your bucket strategies. What did you have to do?
Well, it didn't change the strategy per se. It changed how much we had to have in different buckets, because if we are, and the good news is, though, where it affected things the most, at least from an emotional standpoint, it was bucket number 1. The money we're going to spend in the next 5, 6 years, 7 years. Mm-hmm. We went from, earning, 3.5%, 4% over time to earning less than 2% over a 5, 6, 7 year period of time.
Yeah.
And so it takes a little bit more money to do so. But the good news is, though, that it's a shorter period of time. So the difference in that 4 versus a 2 versus a 1.5, give or take, whatever, is not measured in difference of years or, 30, 40, 50% more money in bucket number one. You miss out on, you add a couple more months of money because it hasn't had a real period of time for compounding. But the difference between a 2 and a 4% rate of return over 30 years is a very large number. Mm-hmm. The difference between 2 and 4% over 5 or 6 years isn't anywhere near as big because compounding hasn't had as much of an effect on the overall balance. And so luckily we were dealing with the shorter term rates. But the big issue was emotional. It just stunk to high heaven looking at your bucket number one and not earn anything. We want, in bucket number one, just as a quick refresher, we want high liquidity or availability of money at the right times, not locking it away. We can maybe ladder something 1 through 7 years. We want high safety, high conviction on the principle of the money. We want to be able to make sure that the money, a dollar is a dollar or close to it, and that we can get to it when we want it in a short period of time. So liquidity and safety are the two primary factors in bucket number one. And to get that, you have to accept a significantly lower yield. The advantage of today versus just a year ago is that we're actually earning something. Now we're so conditioned to bank, bond rates and their, CD rates being, sub 2% for so long. 4% is kind of exciting,
isn't it? Though I mean, isn't
when
it?
The reality is, it's more historically normal than it is extraordinary.
You couldn't get us excited over 4% CD rate 20 years ago. If you,
that was low.
It was, and this goes back to my thought about how you have a kind of satisfaction cost basis. It's been so low for a while that all of a sudden, when it jumps from 2 to 4 or whatever,
right?
I mean, it seems great.
Yeah, and it does work. I was speaking with somebody just the other day about their bucket number one, and we're reinvesting some of their bucket number one into treasuries and things of that nature at mid to high 4s. And they're saying, well, we're a little ahead on bucket number one, aren't we? Then, well, yes, we're ahead from where we thought. Our expected rate of return is less than half of what we were dealing with here, and we're earning a lot more. But there's that little dark side of it too. That one of the reasons they're higher is inflation's a little higher too.
Yeah, well, of course, yes, and you may need to take some more out of that bucket number one potentially.
Yeah, and so it's a double-edged sword. But yes, we're finally able to earn something now. What I saw at the brick and mortar banks were that the savings accounts at brick and mortar banks have not come up.
Nope.
They're still in the 0.0 nothing type range.
Yep.
Online banks with FDIC insurance are significantly better. They're not at a treasury rate, but they're immediately liquid rather than 6 or 12 month tie-ups.
Yep.
But so you can get, and you can ladder, and you can actually get a return on your bucket number one safer investments. And even on the longer period of time, for somebody who's very conservative, you can guarantee, like for that longer side, like if you're laddering out 5, 6, 7 year money, you can guarantee 5s. At least when we tape this, you could.
Well, yeah.
Tape. What am I talking about? Tape.
The recording, the digital recording of this. So now, I mean, we've talked about how in the past you really had to get tricky. People did not like to see the low rates of return that they were getting on their bucket number one.
They understood that they were giving up that for the safety and the liquidity that they wanted, but it still didn't sit well with you.
Sure. I mean, you don't expect you don't have a bucket one. You don't get a bucket one for its rate of return.
Well, you get bucket number one for the liquidity and the safety.
And the safety that it provides. Yes. So, but you still would kind of like to see.
Oh, it's still no fun when you tie up a couple $100,000 and you see 42 cents in interest on a monthly basis. That wasn't any fun. Okay, I was exaggerating there, but it wasn't too far off.
Well, all right. So before now, would you see people with maybe more cash in their bucket number one when they really weren't getting anything out of a 1 or 2 year CD, or were you seeing? I mean, I know you guys put them together, so you may not have done that. But did you see people potentially maybe holding on to more cash than they should have?
Oh, a year ago, no. We saw more people pushing it into the market than maybe they should have, because they were more excited about the returns of the market, and they were saying I don't like the price that I'm paying for this safety. The markets are going great. They've been going great. Okay, there was a blip in 2020. Big deal. There was a blip in 2018.
Big deal.
I'm going to take my chances with the market instead of this, paltry little nothing I get in bucket number one. Which
big mistake.
Is a mistake, because when we start chasing return, it may work for a little while, but at some point it's going to turn around and bite you in the hindsight.
Isn't that what happened as of January of 2022, about a year ago?
In some cases, when we were actually trying to preach the opposite of, hey, the markets have given you significantly more than you expected, let's pull some off the top. A lot of people, and we look at the numbers of the inflows and outflows of mutual funds and investments, and the inflows were much higher on the equity side than they were in the safety side.
So the prices were high. They were the highest they may have ever been in some cases, and people were pushing money into them, saying, "Let's get this. Forget this safety stuff. We need to buy equities."
I can't afford the safety stuff. It's not paying me. It's not rewarding me. And the reward isn't in the return when you come to safety and liquidity. The reward is in the not losing anything.
So what people were doing, now not everybody, but you have seen instances, I'm sure, where what you're saying is you've seen instances where people were looking at their bucket one and saying, why is this money sitting here earning nothing? And I'm saying a year ago, or even prior to that, when doggone it, this could be working for me. There's just
right.
why am I putting all my dollars on the sidelines when it could be in the game?
And if you have the appropriate strategy that identifies when you're going to use those dollars, you can say, I'm not going to use, I've already done my analysis. The money that's this amount of money, I'm not going to spend for 10, 15 years. Well, that is appropriate to be invested for the potential of growth, but expect some volatility. But if you've identified that this money that I'm going to spend is either for my kids' education next year, for the first year of my retirement, for next year of retirement, next 2-3 years of retirement, I can't take any chances with that to get that potentially better rate of return that the markets will hopefully provide. Because to get that better potential rate of return, you have to accept the risk that goes along with it. So the first thing is have a strategy that identifies what money is to be used when, and then, like we've talked in the past, match your asset and your liability. Liabilities, I need to spend money. The asset to support that, if I need to spend money in the next 2-3 years, that's short-term asset for that short-term liability. If I've identified the fact that I'm not going to spend this money in my lifetime, I'm really investing it for my kids or for some emergency long-term care in the future, maybe, that's hopefully in the very distant future, and I can take more risk with that. I can try to get that better return.
The whole point of buckets, which is why
the whole idea.
It's set up that way. All right, so now that we've got the higher interest rates, we have much better rates on just about everything that you're going to get at least in a bank, other than just a passbook savings account type of thing, or a interest-bearing checking account, and certain interest rates from insurance companies as well. How would you structure somebody's buckets one and two differently, maybe?
Well, what we've been seeing with bucket number one is instead of using a strategic bond allocation where we've got a smattering, short-term, long-term, trying to do some risk-adjusted, and this was what was happening in 2019, 2020, 2021, where we were using mutual fund bond portfolios that, you had some high yield, some government bonds, some corporates, and different, trying to match, get a little bit more juice out of the longer term, but protect it with some shorter term, have it with a strategic bond portfolio. They did exceptionally well for what we expected in 2019, 2020, 2021, which should have been a tip off that at some point, what goes up, sometimes, it comes back, reverts back to the mean. But now instead of using those types of portfolios, we're seeing more laddered treasury and fixed annuity portfolios, where we can lock in guaranteed returns, from a 1 year. If I need, easy math, $10,000 a year from my portfolio, and I'm just doing it very simply, I have $10,000 in a bank account that's earning me something. That's what I'm going to spend for the next year. I have $10,000 in a 1 year treasury bill. I have $10,000 in a 2 year treasury, and then you can go and keep laddering up. Maybe once you get to the fourth and fifth year, you use 3 year fixed annuities because they lock in just a slightly higher rate than a 3 or 4 year treasury. That's how you can lock in those. Or we're seeing laddered portfolios rather than mutual fund portfolios for bucket number one.
Which makes sense because we don't know where interest rates are going to be, and you'd like to take advantage. I mean,
we think it's an advantage.
It could be a little bit of a risk based on where the interest rates will be at the end of each of those laddered periods.
And
right?
at this point, looking 5, 6, 7 years down the line, if you're dealing with the treasuries, the 5 year treasury is lower than the 2 year treasury.
Yeah.
And so a lot of people are saying, well, I'm not going to ladder past 2 years. I'm going to put my years 3, 4, 5, 6, 7 money in the 2 year, and I'll reinvest it in 2 years based on whatever the interest rates are at that time. And so it's a gamble one way or the other. Either you lock it in later and with the expectation that interest rates may come down a little bit and you'll get a better rate of return over time, or you play the interest rate game and you say, I think interest rates will be the same or higher in 2 years, and then so I don't want to lock in for a longer period of time.
Well, it's a gamble, but it's a smaller gamble. I mean, you're talking about a couple. You're
talking a couple percent one way or the
You're
other.
not talking about much. And as you said, Professor Plum, I mean, over a smaller period of time, 3 years, 4 years, it's not going to have a lot of time to compound anyway. It's just a psychological feeling that you're doing better.
And it's interesting, the difference between a 2 and a 4% compounding over 5-6 years, and an 8 versus a 10. Obviously they're bigger numbers, but it's still only a 2% difference between those two. But you can get difference. I mean, when you're talking about returns, short term, it doesn't have a lot, but the longer it goes, the more compounding affects you and either helps or hurts you.
Well, I mean, 7 years, 6 years, you can get a decent. It's still a good idea to get maybe
but you still
a better rate of return.
I was talking to somebody the other day, and it's like, well, I don't need to take any more risk, to do something. Well, you don't need to take any more risk, but you can get a little bit better rate of return. Why wouldn't you do that? I mean, even if it's only $500,
who cares? That's $500.
If
right?
the risk is the same, why would I turn down the $500?
But isn't that taxable, Professor Plum? I mean, why would I buy treasuries? You mentioned this. Some people were saying, wait a minute, I can get 4% on a treasury over
2 years, 1 year, 2 years,
2 years, whatever it is. But it's taxable to me, doggone it. Why don't I buy a municipal bond, which is
I don't have to pay any taxes.
And then I don't have to pay any taxes.
Look at all the money I get to save because I don't have to pay any taxes.
Yeah, you're being facetious here before people start to quote you. What's the problem with that?
Well, because there is a give up with that municipal, and it's in the rate of return. Now, we've been quoting rates in the mid fours for 2 year. If you're looking at municipals, they're pretty much 2.5 kind of across the board from 6 months to 30 years. It seems. I mean, they're not.
Yeah. So I'll take half of what I can get almost on a treasury in exchange for not having to pay taxes on the gains.
Yeah. And then if somebody says, well, I live in a state like California where I'm in a very high tax bracket. I'm in the federal 37. I'm making millions of dollars a year. I'm 37% on my federal bracket.
Right.
I'm 13.3 on my state tax bracket. I'm giving up 50% of my return. So that 4.5 is really turning into a 2.25.
Yeah.
Well, the good news about treasuries are, unfortunately, yes, it is subject to federal tax. So you're giving up the 37%, but there's no state income tax on them.
Yeah.
And if you're in that category, that's about the only people that should be looking at municipals really are the very high income individuals because then
taxes become the consideration.
Well, no, the same consideration is due on everyone. The taxes is not the consideration. The consideration is what do I keep in my pocket? Well, how much?
Yeah, but
and if I can keep more in my pocket even after paying taxes, than I can keep without earning taxes.
Well, of course, yes.
I'll earn, hypothetical, facetious.
Yeah.
I'll earn 10% and give up 4 of it to taxes instead of earning 5.
Yeah, well, I would too.
Or 3 or 2 or something. So it's, not paying taxes isn't the issue with municipals. It's a matter of, can I keep more money after all said and done?
But taxes are the things that prevent you from keeping that money.
Yeah, and the majority of the retirees that aren't in that super wealthy area, the majority of their money is in an IRA. Where the
no, that's true. That's true. It was just an interesting thought that I had.
Now, there was a period of time back when because I've been doing this a long time, back in the 80s, there was a period of time where for whatever reason, and these anomalies happen from time to time. I haven't seen this since the 80s. Municipal interest rates on municipal bonds was higher than corporate.
Why?
I don't know. I don't remember why. It was 100 years ago, it feels like. But for a while, we were seeing municipal bonds inside of IRAs. But it wasn't to get any tax-free status. It was just that the return was higher than other similar risk individuals. But that was 40 years ago.
Were taxes, local taxes higher then?
I don't know. It was just an anomaly where whatever the risk factor was.
You remember
and
that.
It was only for maybe 6 months to a year period of time. But you could get a higher rate.
Now, you mentioned something a little bit ago when you said, well, we can, maybe ladder some treasuries for, 1 year, 2 years.
Once we get past 2, though, they start to, either flatten out or go down slightly.
Right. So people will say, well, what else can I use? You mentioned one option was to take maybe
fixed
2
annuity.
years. Or they, ladder 2 years over the rest of and see where interest rates are at that point. But you mentioned the A word again, fixed annuity, fixed index annuity, whichever.
Well, for short-term 3-year rates and things
How are
like
these?
that,
How does this work for people that don't understand and who have heard that you should never put an annuity inside of? You should never own an annuity
ever.
Right.
The fees are just way too high, is what they say usually following that.
And what are the fees on the fixed annuity?
And the fees on a fixed annuity, if you hold it for the prerequisite time for the surrender period, there are no fees. And so it's like, what are the fees on a CD?
Well, it's baked into your rate of return.
Exactly. And there's a substantial penalty for early withdrawal.
Right.
Well, with an annuity, there's a substantial penalty. It's just more substantial.
Actually, it withdrawal. Is. Those surrender penalties are not.
They're onerous. So you don't want to surrender them. So you want to make sure you have the appropriate amount of liquidity to hold that for the 3 year.
So what happens? How does just in a nutshell it for me here?
A fixed annuity is issued by the insurance company. So it's the insurance company guaranteeing the principal and the rate. And you can get fixed annuities where the interest rate floats every year. I, for one, particularly don't like those too much. When I have a surrender charge that lasts for 3, 4, 5 years, giving the flexibility to the insurance company to change the rates, they hardly ever do that in my favor. They're going to do that in their favor. I'm sorry.
Well, they're going to take their profits first, right?
And I like fixed annuities. This is my personal opinion, where the interest rate is guaranteed for a set number of years. And at the end of that set number of years, there's no surrender charge left. So a 3-year fixed annuity may pay, 4.8, 4.9%. I don't know what it's paying, but close to that. It'll get that each and every year. It won't be higher, won't be lower. Principal's guaranteed by the insurance company. And the surrender period is 3 years. At the end of 3 years, the insurance company is going to change the rate that they're paying me. But if they don't change it to a rate that I like, I can say bye-bye, and I can remove my money on all the earnings with no surrender charge, because the surrender charge was only 3 years as well. Mm-hmm. So I always want to match my rate guarantee lock with the surrender period. I don't want to go, you can get a 3-year rate guarantee with a 5-year surrender period. Well, that means you're worried about the last 2 years.
What good does that? How does that help? Yeah.
And at that point, we look at, well, what's the worst thing the insurance company can do to me for those last 2 years? And we calculate the rate over the 5 years and say, we call it yield to worst.
Yeah. YTW.
And say, what is the worst that I can get out of this? And is that an acceptable rate of return? Sometimes it is, sometimes it's not. So we look at fixed contracts from the insurance companies as what are they guaranteeing to pay me, making sure through other assets I have enough liquidity. And I can get, like I said, high 4s on a 3-year contract.
What are the tax considerations generally, state and federal, on an annuity that you hold for, say, 3 years?
Well, obviously, if it's inside of an IRA, there's no double secret probation taxation here.
No. Okay.
There's no special treatment to taxes. Not when the money comes out of the annuity, but when the money comes out of the IRA, it becomes taxable regardless of where it came from.
Ordinary income.
It's just ordinary income. So there's no advantage or disadvantage inside. You're just buying it for the yield.
Yeah.
Personally, if I buy one personally, it is a tax deferred interest, so that 4%, I don't pay taxes on it until I pull the money out. That sometimes is a good and sometimes is not such a good thing, because now I'm building up more taxable income for later on, where maybe I could be paying some lower taxes today. So we have to play with that game, but it is a tax deferred. So the interest, so if I put $100,000 in and I'm earning 4%, I have 104 at the end of the first year, no taxes due. 108 and change, 112.5 or something that after 3 years, I pull the 12.5 out. That's when I pay the taxes. And so I pay taxes on 12.5. I pay taxes on whatever I pull out of it to the amount of deferred interest is in the contract.
But it is a consideration.
It's always a consideration.
But it would be for the CD.
But it's also a reason why I don't like them to sit there forever in a personal account, because they just grow ticking. You can almost hear the ticking tax time bomb, building away
in a personal account.
If you leave it for, a long period of time, somebody someday is going to pay the taxes on that. Unlike a stock, or something where you put 100,000 into a stock. It's a pretty good size number for a stock, but and it grows to 250,000 over the next 20 years. Purely making this up. And you die.
Oh, well.
Under current law, that 250,000 goes to your heirs without any capital gain on that 150,000 of built-in gain. That gain evaporates. It's as if your heirs bought it for 250.
It's what they would call a step up in basis.
That's a step up in basis.
Yeah.
Yeah, an annuity is a deferred interest. It's not a capital gain contract. And because it's not capital gain, and because it's interest, somebody someday is going to pay that the tax on that interest that's deferred. And so if I had a $100,000 contract that grew to 250 and I died and I left it to my kids or left it to anybody other than a charity, they get to pay the taxes.
I was going to say, maybe if you're going to give money to a charity, give that to the charity instead.
We just had a client that had a very large, nice portfolio. They've got they've been doing Roth conversions, so they've got a really good sized Roth, a good sized IRA, but years ago they bought some annuities and they've got some huge gains in their annuities as well. And they don't.
What kind of annuities are they?
Well, they're fixed index annuities now.
Okay.
But they've still got a lot of gain because they've been changing it from one annuity company to another company with a tax deferred exchange. So they're getting older and their spouse doesn't need all umpteen millions of dollars. And so they're leaving the Roth to the kids and the IRA and the Roth is the bigger piece now, and the IRA and the annuities to the charities of their choice. And the only person that's going to miss out on that is Uncle Sam.
Yeah, no, it makes sense. Makes perfect sense. You talked, before we run out of time here, you talked for a moment about people who have held on to some of these annuities for a while. If you've got people who have been holding on to cash, maybe they've got some stable value funds in their retirement plans. They've got some out of surrender fixed annuities, right, that are paying 1 to 3%.
Now, you mentioned something before you go on to your question. Hold on to your question.
Okay.
You mentioned stable value funds, and stable value funds have been a pretty nice little piece of bucket number one for a number of years.
Sure.
But the interest rates on stable value funds tend to lag the
rest
movement of interest rates in the market. So when interest rates were coming down and staying down, they tended to be higher comparatively for the same type of risk. Stable value funds basically don't have much risk. So they were a little higher than what you could get outside. Now, stable value funds are only available in 401ks, specifically larger 401ks. And so they were a nice place, a nice store of value for bucket number one if the 401k was flexible enough to deal with it. But they lagged when the interest rates were coming down, so the rates stayed a little higher. But they also lag when the interest rates are going up, and so they tend to be a little lower than what you can get in the outside world away from the stable value fund with similar risk characteristics.
Yeah, well, and so this may be the time, if you've got some of those older annuities or stable value funds that are lagging a little bit.
Well, older annuities, I mean, just a year or two ago, a good 3-year rate was sub 2%.
Well, yeah, and I'm thinking maybe
but an
old enough
annuity,
to be out of surrender.
Yeah, out of surrender, because you always have to consider that surrender charge. Fixed index annuities. Index annuities are where you receive an interest rate that's not stated up front. It's a strategy or some kind of a formula based on the movement of an index. The index could be a bond index. It could be, most likely, it's a stock index, most common being the S&P 500. If the S&P 500 goes up, you get an interest payment on your contract anniversary subject to a participation rate, a cap rate, a spread rate. There's some factor in there. Cap rates a year ago were 4, 5, 4.5, 5. Cap rates today on new contracts are 10 plus.
You say cap rate, just quickly for people who are saying, what is that?
The interest that you receive on your contract value is based on some underlying strategy. The most common is the S&P 500 1 year point to point, meaning if my contract anniversary was a year ago, they look at the value on the day I got in, and then a year later, what did the index, in this case we're using the S&P 500, what did the S&P do over that period of time, 1 year? Did it go up? Did it go down?
How much did it go up or down?
How much it went down is not
Doesn't
the factor.
matter. But let's say how much
on
did
the
it go
upside
up
is a factor.
Yeah.
So we got it a couple years ago. We got it 2 years ago, and in 2021 the index went up 27%.
Well, you're not getting 27%.
At that time I would have gotten maybe 4.5%
and
interest. I have no risk in it. The principal is guaranteed. I'm not actually investing in the index. They're just using the index to determine how much interest they're going to pay me. So that year, I got my cap rate of 4.5%.
Cap meaning the top.
It capped me out.
Yeah.
And then this year, they looked at it and they said, well, the S&P, there was no positive performance over the last 12 months in the S&P 500. So you don't get any interest. Now, I didn't lose anything either with a fixed index annuity because the principal is fixed. But cap rates for several years prior to this one were in the 4s, maybe 5 if it was really, exceptional. Now I was looking at them just the other day, they're 10 plus. So if the index goes up, if it goes up 6%, In my old contract, I only got 4.5%. This
now
one I
you
get
get
my
the
6.
full 6.
I get
yeah.
everything on the upside up to the cap rate. And
Do you keep those cap rates?
Well, it depends. Insurance companies work off of 2 different basic philosophies when the cap rates are set.
Not to get too into the weeds, but I just for
if
people
you
who want to know.
Yeah, they will either use a new money rate where they basically expect to reset the cap rate close to what new money would be, new money coming in, or they do what I call a portfolio rate. They say where they basically try to set all the years of the surrender period up so that the renewal is, they're buying it all right now, and they're trying to set the renewal up to stay fairly close to what they started with.
Okay.
Now those are the good companies. There are other companies that issue with strange cap rates, really high in the first year,
and then
knowing
nothing.
that they're going to drop it down to nothing after that. So you want to look at the insurance company if you are evaluating a fixed index annuity. One of the first things we ask somebody that's coming in to tell us about a new fixed index annuity is, what's your renewal history? What's your renewal cap? I call it integrity. What's your integrity on your renewals? How close to
what you?
How are you setting them? Are you trying to set them to maintain the cap rate, or are you trying to set them to move with the new rates? Because if interest rates go up, it'd be nice to get that new interest rate. But then on the other side, if things go down and the pricing isn't there, and the cap rate on the new money type contracts, the cap rate's very volatile. They go up and down a lot.
It is.
Sometimes in this kind of environment, it would have been good, but in most environments, it didn't work.
Well, this is why I think you need to go over this stuff with your advisor. If you haven't looked at your bucket one, if you haven't looked at your more conservative holdings, perhaps the conservative portion of your portfolio, maybe it's time to take a look at it and go over it with your Lucia Capital Group advisor. This is something, if you can take advantage at all of the current higher interest rates, and you don't have to hold your money, to get the good interest rates or the highest type of guaranteed government rates. If you don't have to hold it for 10 years or 20 years or whatever it is, it may be a good opportunity to take advantage. Professor Plum would be the first one to tell you that. I'm the first one to tell you that, but this is sort of why we're doing this podcast. If you want to get in touch with your advisor at Lucia Capital Group, Professor Plum, you guys are, I'm sure, you've already done this for a good number of people over the last couple of months.
Well, we're reviewing people's contracts, or not contract. Well, yeah, the contracts.
Well, yeah.
Well, their whole strategy.
Yeah.
Every year, every 6 months or so.
Yeah.
We want to review with everybody every year, every 6 months. And so we're bringing all these kinds of things up.
So if you got that, you got some extra cash, maybe you want to know what to do with it on the safe side. As we mentioned, the stable value funds, which you may be able to get a better deal on, who knows. Check some of the treasury bills that you've been holding on to. Give the folks at Lucia Capital Group a call, 800-644-1150, 800-644-1150. You can talk to any of the Lucia Capital Group advisors who work under the direct supervision and, I was going to say tutelage of Professor Plum, but you're not really teaching so much.
Well, I mean,
you do
through helping
through helping. It's a collaborative effort, is what it is.
I was helping an advisor assistant today on all the required minimum distributions that were, which ones were waived in 2022, and which one and are they going to waive them again in 2020?
Well, it helps to have a resource like Professor Plum. So kind of like the Wikipedia, except one that that's a little bit more reliable as far as in the information department.
I think personable too.
Maybe. Depends.
Okay, maybe not.
It depends. Again, 800-644-1150, or go online. You can get a lot of this information at luciacap.com. You can contact us there at luciacap.com, luciacap.com. Don't forget to subscribe to our podcast. I tell you this every single time. We've done well over 100 episodes. We're on like number 120 now. So if you haven't heard the past episodes, we talk a lot about strategy. We don't talk a lot about we don't really talk about stock strategy because we don't believe in that. We believe in the bucket strategy. But you can listen to some of our past podcasts and get a lot of good information there. Articles, blog posts, it's all there at luciacap.com. Subscribe to our podcast. As I said, go to Spotify. That's where you find us, at Spotify. Professor Plum, thank you so much.
You're welcome.
I appreciate the information as always. And for our my esteemed colleague, Professor Rick Plum, CFP, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again, as always, next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Municipal bond interest may be subject to the alternative minimum tax. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Stable value funds can be viewed as an alternative to money market funds. However, there are important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. The structure of or investments within stable value may vary, and it is important to consider these differences in selecting a stable value fund. Before investing, carefully consider a stable value fund or mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Rick Plum and Chris Lloyd are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.